Good afternoon, everyone. Keith Cupp, the CEO of Gravitas Impact Premium Coaches here from Portland, Oregon. Today we're broadcasting, and we have a couple of very special guest experts as we focus on the Global Business Leadership Forum for business owners and leaders and their coaches. And we're focusing today on Cash Part 2. So 1 week ago, we had a webinar which is posted on our website, gravitasimpact.com/corona. Focusing on cash activities by experts from Australia and United States. And today we welcome to our webinar, Brandon Gray from Huntsville, Alabama. Brandon, welcome today.
I'm glad to be here.
Okay, and Brandon is with Carr, Riggs & Inc. He specializes in helping companies, owners, and businesses with managed finance, cash flow, and planning. And then also we have senior coach from Minneapolis, Minnesota, Jeff Redmond. Jeff, welcome to our webinar today.
Thanks, Cleese. Glad to be here.
Okay, so everyone listening in, we want this to be very interactive. And so what we're going to do is I'm going to turn to Brandon first, and he's some content here with us. Then as he's sharing, go ahead and hit the Q&A or the chat, and let's get some questions going for Brandon. Then when he's finished with his mini segment, we'll go over to Jeff. Likewise is going to talk us through a study. I'll interview him on that. And then we'll go back to Brandon a second time. Again, interactive Q&A, back over to Jeff, and then we'll bring things to a close, and we'll go no more than 1 hour today. So if there's any questions along the way, put them up there. I will be monitoring Q&A and chat. Okay, with that, Brandon, I'm going to go ahead and give sharing capability. So I'm going to stop my share, and if you want to go ahead and start sharing slides, let's get started.
All right, sounds good. So, second here, I'll get the slides pulled up. Keith, I really appreciate the opportunity to help you guys, and the goal here is to provide value so that we all can work together to kind of get through this difficult time. And as Keith mentioned, what we specialize in is profitability consulting. We work with entrepreneurs to guide them along that journey to create and maintain, and hopefully in many cases, increase profitability. With that though, profitability is one thing, cash flow is another. And so we're going to kind of be looking at both of those today as the unique position that we're in. As Keith mentioned, feel free, I want a lot of questions. I want this to provide value to you guys. So as you have questions, feel free to send them our way. Keith is also posting a link to a resource page that we have. It's simplenumbers.me/crisis management. I'm going to give you an overview today of some of the tools that we have on that crisis management website. The goal was that we created some videos along with templates that can be used by entrepreneurs to help look at profitability and cash flow and the potential decline that most of us are being faced with right now. Hopefully the ramp back up that I'm confident that we'll be able to achieve at some point in time, and look and see what the cash flow implication of that is. And so if you'll go to that site, you'll find those resources there. We want you to, we designed them so that the entrepreneur could spend a little bit of time and hopefully in a very easy fashion determine that cash flow need as well as looking at profitability. So we want you to use them and do as much of it you can as, on your own. We tried to design it as a DIY tool. If for some reason you get hung up or you do want assistance, feel free to let me know, and we're happy to chat about that. That said, I want to give you an overview, a high level of what those tools look like, and also I think this will probably bring about some questions too as we go through things. And so,
hey, Brandon, just real quick for a viewer user friendliness, would you hit your larger screen view of your slides there? Thank you.
Yep. Sitting here. There we go. Can you guys see that okay?
Perfect.
Yes.
Awesome. So where are we at? What do we need to do? And I think most folks have already started the planning process. A lot of you have probably already looked to see what your outage is potentially going to be, and maybe even have submitted some SBA loan applications. There'll be more information, I'm sure, about that as we go through things today. In terms of the planning, though, we need to look at this in a handful of chunks. So the first thing is we need to look at where things may be around 90 days from now. The million and perhaps $1 billion question that is at hand is, how long is all of this going to last? And unfortunately, no one knows for sure. But that being said, we want to look at a minimum of a 90-day plan. From there, hopefully things are starting to return back to some semblance of activity. May not be fully where we once were, but hopefully we're starting to improve. And so then you look at an additional 90. So you would basically have a 180-day plan of what things are going to look like. Once you've put that in place, then we can evaluate what is the cash going to be needed in order to survive the next 180 days. Because as you'll see as we go through things, there's a difference between profit or loss and cash flow. It's one thing to kind of keep operations going. It's another thing to have a decline and then have to crank them back up. As I tell a lot of our clients, it's not the ride down that hurts, it's the climb back up. And that's what we want to make sure everybody is prepared for, and that we have, as we like to say, a little bit of dry powder still remaining so that we can perhaps even play a little bit of offense as we go through this. So that said, here's some tips that we're going to go through in terms of forecasting. And it's more of an art than it is a science. And so the first thing we're going to ask folks to do is to plan out what we refer to as gross margin. And what we mean by that is going to be your revenue and any direct costs associated that are not labor related in order to achieve that revenue. If you're a manufacturing business, for an example, this would be as simple as revenue and the materials involved. If you're a service base, you may not have any direct cost. And so start there. From there, we need to look and see what type of non-labor expenses can we shave. So go, take the grueling exercise of going through that detailed P&L and trying to determine what can we live without for the next 90 to 180 days. Once we've made that round of reductions, we then unfortunately have to look and see, well, what is the labor requirements to run this plan? And so we want to have an idea so that, should we have to make labor changes, we're prepared for that. Hopefully we can have some assistance through the payroll protection program that would help cover some of that gap as well. Last thing we typically look at is going to be the administrative/management labor costs, because those are typically resources that we need to be able to relaunch and ramp back up. From there, we can start to determine, okay, this is the amount of losses I'm going to incur, as well as what my runway looks like from a cash flow perspective.
Hey, Brandon, coming in, when you talk about start with gross margin, that includes existing recurring revenue margin and any new sales, is that correct? Exactly,
or the loss thereof. I'm hearing different things depending upon how much you've been impacted. A lot of clients are saying, hey, we're just not adding new revenue right now or new gross margin. Other folks are seeing folks perhaps postpone services, and so they're seeing it come down, and obviously retail and restaurants and what have you are pretty substantially impacted right now. Great question.
Brandon, how often do you go through the cycle you just shared? Is that weekly, monthly, over the years?
Great question. And so I'm going to take an initial cut of it now. And then as weeks move on, I'm almost managing the business a week at a time. Because it seems like each week, I came across a quote at the end of last week. It said, there are decades when nothing happens, and then there are weeks when decades happen. And so in those weeks when a decade happens, we may have one game plan going into the week. We may have another coming out of it. So the key is going to be flexibility.
Thank you.
Yeah. Great. In terms of the difference here, and I'm not going to read this verbatim, this presentation, once again, is available at that link in a more in-depth manner. But keep in mind, you may have profit or loss on your P&L, but how much is it going to cost me to, once things crank back up, to fund my receivables again? And if I have a business that requires inventory, I've used my inventory to kind of get me through this hard time. I've got to go now back out and purchase inventory again. And so what's that cash flow implication between those two things? And what we're seeing is that the businesses that have to carry both inventory and receivables obviously are the ones who are going to have the most of a gap to cover from a cash flow perspective. We go through in the presentation in very depth 3 or 4 different examples there. So like I said, feel free to take a look at that as a recorded webinar. There's 3 primary business models that we see, and there are templates available on that website for each of these. So depending upon your type of business, you kind of can look at that for a little bit more of a customized approach. We keep it simple. We're from Alabama if the accent doesn't give it away. So we just got three categories. You either do stuff, so you're in the service business, you sell stuff, you're a wholesaler perhaps, you're in product sales or retail, and the third thing is you make stuff. And you either do one of the three, or in some cases, a combination, a hybrid of those. And so depending upon what your signature looks like there as a business and what you perform is going to impact you pretty substantially from a cash flow perspective. As I mentioned earlier, if you carry inventory and receivables, it's a little bit different than the folks who, receive the prepayment, or they pay, customers pay up front for service and they carry no inventory and no receivables. So looking at those three different examples, and we go through those templates in that video.
Brandon, another question coming in. So in casting at the top line and gross margin, are you recommending also making some assumptions about churn or loss of clients or revenue also?
Yes, I actually like to run a couple of different scenarios. One that, you kind of have to do a worst case scenario to see potentially as it could look. If you're looking at potentially seeing business decline by 50%, what does that look like? Run another scenario that's maybe a 25% decline, and then one as if just based upon what we know today. And then from there, I want to look at what we call leading indicators. So what information can I gather during each week to give me some indication as to where that gross margin is going? And these are things you probably took for granted previously, and maybe you just had a gut sense of where things were going. But given the circumstance now, you actually probably need to track that. Hey, I had 5 customers call and were questioning me about their services and what I potentially could do. Well, it's a leading indicator to tell you you're probably going to start to see some decline. Or I had 5 people actually call and inquire about services. Well, maybe we're starting to see that change a little bit. And so using those leading indicators to kind of help you call which plays you need to run. Great question. All right, so we've kind of broken down capital into 4 different needs that every business has. Now, these are going to vary depending upon the type of business, but the first one here that we refer to is called trade capital. So when you're looking at how much cash do I need to get through this downturn, these are the 4 areas you need to take into account. And so you start with the trade capital, and that's basically what I have to cover in my receivables and perhaps inventory and WIP if I have that, less what do other people cover for me, my vendors, any accrued expenses, deferred revenue if people actually prepay me. And so what does that gap look like? And we call that trade capital. It's very important as you predict how much cash you're going to need to ramp up, because if I have great terms with my vendors, maybe I don't have to pay them for 90 days, but my receivables come in 30 days. That's obviously going to help us cash flow wise. The second is infrastructure capital. So, this is anything that you would have to purchase above what you could borrow for equipment and other depreciable assets. I would suspect during this time, that's probably going to be very, very minimal. It could change, but I think for most part, we're not forecasting most people to need infrastructure. The third one is what we would refer to as buffer capital, or if you're familiar with some of the simple numbers terminology, it's also referred to as core capital. This is the amount that we need set aside in case things don't go as planned, to give us some cushion so we can keep maintaining operations. And right now, I'm not having to convince anybody that this is a need in businesses. And then the last one is what we call as launch capital. And so this would be any type of loss or activity that you have to fund until that activity becomes cash flow positive, meaning you start to break even on it. So it could be you realize coming out of this that there's actually an opportunity to offer a new service or a new product. Well, what am I going to have to invest today to maybe start marketing that and develop it until I'm able to actually offer it into the public and it become profitable? So there could be some of that. I've got some clients that are looking at this as an opportunity, and they're actually seeing, particularly like in the IT space with as many people working remotely as we have, they're seeing opportunity there. And so what is it do I need to have set aside to cover that? Okay, any questions?
Else right now?
All right, so depending upon the type of business that you have, I'm not going to spend a tremendous amount of time on this one, but basically this breaks down the different needs that businesses may have based upon if you make things, sell things, or do things. And as you can see, things such as your trade capital, if you make things, I've got to carry quite a bit of inventory and receivables in many cases. If I sell things, similar type of situation, I have to carry that, but many times I'm also getting really good terms from my vendors. And if I'm in the service industry, then perhaps I only have receivables. And so depending upon, your particular business, this is going to impact you in terms of determining the amount of capital you need to have on hand. And once again, we kind of talked through this in detail in those presentations. I mentioned a moment ago that trade capital is essential as you look at kind of relaunching. And so we refer to this in an upcoming book that we're about to release as CPR, the cash power ratio. And kind of think of it in terms of, if I'm having to fund more in my receivables and inventory than I have vendors or customers prepay for, it takes a substantial amount of cash to grow. And you may actually burn cash through growth. And in most circumstances, we're talking about this and trying to bootstrap growth. And a month ago, that was the conversation we were having with clients. So great, you want to grow, sounds great. Here's what it's going to take to fund those receivables, to fund your inventory and what have you. Well, the principle still applies now, but the context has changed. It's changed to whenever we are through this downturn and we're now having to relaunch the business, here's the amount of capital that you're going to have on hand to do so. And so in that template and in those tools that I've mentioned a handful of times, we discuss that and how to calculate that and determine this is really how much I need to keep on hand. So another strong concept. Once again, profitability is one thing, and the thing that if you take nothing away from what I'm going through today, I want you to take this away. Profit's one thing, but I can't forget about the cash flow implication. Because you can look and see how much loss I'm going to have over the next 3 or 4 months. But if I make it through, will I have enough cash to relaunch? That's the real key that we want to make sure folks are prepared for, and that you have arranged financing for if you need it. Just mention this in terms of trade capital and the importance there to kind of getting back up and going. We were talking about launch capital, and I'll be ready. This is the last one until ready to throw it back over to you, Keith, here. But in terms of trying to predict too, do I need to keep some dry powder set aside? So for example, marketing is a great example of this. As we're starting to come out of this downturn, which we believe, the economy was super strong and healthy coming out of it, and hopefully, we can get back to some sense of normalcy at some point in time. It's going to take a while. I'm not naive in that regard. But that being said, we will return to activity someday, and there will be customers who want products and services. And so we need to reserve some dry powder to perhaps start marketing a little bit ahead of the curve. And so this is just an example of what we'd refer to there as launch capital. How much money do I need to set aside? Because as we come out of this thing, I'm going to crank the marketing engine back up before we're fully there yet, because I want to get ahead of the curve. And so in doing so, identify that spend. How long do I need to have this spend take place until I start to see it generate profits for you? So if you kind of add that together, what are my losses going to be? What's my cash flow requirements going to be? And do I need to set aside some capital as well to kind of relaunch things in terms of things like marketing and what have you? Start looking at all of those components, and we then can determine here's how much I might need to arrange from a financing perspective.
Okay. And Brandon, in a few audience, we're going to talk about new sources of capital. And so Brandon, just in a comment, some of the FA or governmental assistance programs, grants, loans, and so on, a portion of that we use relaunched capital, correct?
Correct. Particularly the economic disaster relief program.
Mm-hmm.
The intention of the payroll protection is to fund payroll, mortgage payments, rent, and utilities. It's not intended to fund marketing activities to relaunch your business.
Okay.
Now, the other one is. So
a really big takeaway for everyone listening, you can plan to make it through on existing financing and cash flow, but you also have to build in relaunch funds. Otherwise, you may not have the fuel to relaunch and get the revenue engine going again. Okay.
Exactly. Go back in time to when you started the business and think about how you had to work for 60 days and pay all of your expenses before that first nickel of receivable showed up. And it won't be as extreme, hopefully, but we're going to be back to having to relaunch for a lot of people. Similar type of situation.
Okay, good. So Brandon, if you'll hit your stop share there, and then
Yes,
I'm going
sir.
to go to Jeff. And Jeff, you and I had a conversation yesterday about study, and this may be a good illustration of putting things on hold in preparation of relaunch. And so, Jeff, we'll talk about your customer case study, and then a little bit later when we come back to you the second time, talk about sources of new cash from the programs. But Jeff, can you frame out for us your customer in Minneapolis there that we've shared a little bit about the extreme measures in a good way to ensure they have a high chance of making it through? Talk us through that.
So client is a large retailer. They do around $50 million a year. They have 7 retail locations. They sell bigger ticket items to over 250 employees. Interestingly enough, we closed we changed banks and new line of credit, term loan, which actually saved a bunch of cash flow for us. We closed that on a Wednesday, and Friday is when kind of the world started coming to an end. Not sure we would have gotten that loan had we waited another week, but we're positioned with really good bank partnership in place, and I would encourage people to make sure that they maintain a good relationship with their bank and stay in communication. As the crisis began to evolve, the social distancing caused us, and this was March 17th, we actually closed our retail locations to the general public, and we started trimming staff. But we remained open by appointment only. And interestingly enough, our sales only went down by about 30% during the appointment only phase, even though you couldn't just walk in. If you showed up at the door, you would see a sign that says immediate appointments available and a phone number to call, and someone would greet you, and so you could come in. But the purpose was to protect employees and customers and really the community by enforcing social distancing before the governor of Minnesota mandated it. Then about a week ago, Friday, the governor of Minnesota issued 2 weeks of shelter in place, so closed all non-essential businesses. So we were shut down completely. And so we laid off 250 employees and have a core of about 20 people still trying to just keep things together. In terms of cash, the early analysis was, hey, the government has expanded unemployment. They've made it almost instantaneous for employees to access online. You don't have to look for a job, so why not allow the government to take over our payroll responsibilities? Other competitors in our market kept employees. They didn't have to work, but continued to pay them. Our feeling was we should preserve cash for just the reason Brandon suggested, that when we get out of this, we're going to need cash to relaunch. So our strategy from the very beginning was to hoard cash. So that was the very first steps in terms of limiting labor, that when sales weren't going to happen, so now we've been almost 2 weeks without any sales, and you still have rent, utilities, all kinds of expenses. So we've also crafted a letter to basically all of our vendors and landlords saying, hey, we're suspending all payments until we figure out when we can open our retail locations, get cash flow going, understand the stimulus bill, what assistance is going to be available, and really no resistance from any of the landlords and vendors. The world, this isn't an isolated circumstance. Everybody's kind of in the same boat.
Hey, Jeff, a quick question. Now, you also are an attorney and a coach. And so comment on this. When those letters were sent, were they followed up with calls from leadership? And if someone listening in is in retail, they've lost all their revenue and they choose to do this, should they include their counsel into the letter communication strategy?
Sure. As lawyer, absolutely, you should involve your lawyer. That's and you should involve your CPA for Brandon's perspective. We have my client is a very principled person. We did not send this letter without a personal call.
Good, good.
Hey, we're going to, this is what we're doing. I want to send you a letter that outlines what we've been doing, what our strategy is coming out, best we know, and that we want to work with you. So we had very personal communications with each of our key vendors and all of our landlords. We divided up, we have eight big leases, including a distribution center, and we divided up and who is the best person to talk to the landlord representative before they received the memo. It was a memo rather than a letter.
Okay, thank you for that.
What else do you want to know? What do you think is relevant?
Let's see, a couple of things. So what I heard you said, this is an extreme one. Let's say 80% or more revenue loss. And so there's some very positive extreme measures for the right reason, because a business that doesn't make it through can't employ talent or pay suppliers in their ecosystem. They're drawing in very deeply, stopping payments, cutting back talent, all very difficult measures to make it through. Jeff, what are they thinking about relative to government assistance and also innovation? What are they doing with their time relative to looking at the future as well as finding other sources? And we won't go into the programs until the second segment.
Yeah. Well, interesting enough, you think that your business is shut down and you aren't going to, you have nothing to do, but I would suggest that the CEO of my client is working 18, 20 hours a day. I get communications from him as early as 6 in the morning and often at 10 or 11 at night. Sometimes I take the calls and sometimes I let them roll over to voicemail. We've used this, I can't remember the Chinese definition of crisis, but half of it is opportunity. So from the very beginning, we've talked about, do we want to relaunch in the same way that we were heading forward? We have a very specific plan. And so we're putting into place some key changes to the business strategy and business model moving forward that we think will increase both competitive advantage and margin, so that we will be more profitable coming out. And it just gives us a natural, the crisis gives you a natural place to rethink things. So we're very much are looking at using this as an opportunity to reshape our business strategy and working diligently on that. In terms of cash, in terms of the things that Brandon, so I'm not a CPA. I've never prepared a financial statement. I don't even balance my own checkbook, but cash, I've advised clients and organizations for 20 years on finance and finance related stuff. And I'm simpler than Alabama. I am just a cash guy. And so often my clients, the business owner, defers to their accountant and finance people about finances and cash. And I'm very much a believer that finance and cash is really an operational thing. So don't let the finance people drive the boat. that the people in the best position to understand the cash expense of time, inventory, are the people on the main line in charge of those functions. So that's where we're driving for assistance as managers. What can we do today to limit the amount of people that have on the payroll? And we were a little bit slower to decrease employment because we let the managers make the decision and not an edict from the CEO. Mm-hmm. And each manager took a little different approach. And as the crisis became more critical, we had to make deeper and deeper cuts. But we're really encouraging decisions to be made at the line level. Every one of the P&L lines, somebody should be in charge of that and seeing if we can defer, limit, save, whatever. And that's where our cash management, and we're basically hoarding cash. We have the cash to pay all of our bills, but we don't know what it looks like yet for the relaunch. We don't know how long it'll take for the economy to start coming back, people to start coming through the doors. Guarantee it won't be instantaneous, but that's why we're planning kind of for the worst and hoping for the best.
Okay. Brandon, if you want to bring your slides back up, I'll give another quick update. So everyone listening in, a couple of important things Jeff just said. Jeff chooses not to come from a finance background, but an operational background. We have invited him to write a monograph on the cash attribute of the 7 attributes. That'll be coming out in the near future. And a couple of best practices: engage your team to find where the leaky cash may be, as well as ideas to improve and strengthen cash, and assign every line item on the profit and loss statement accountability to an individual in the company to watch that every week. A couple of best practices. Brandon, back over to you.
Thanks. So the next part here, I want to go through the tool itself that we've developed for entrepreneurs to use. Once again, to Jeff's point that he made a moment ago, we don't want you to rely upon a third party or even someone else on your team to go through this. It's not a massive amount of entry, and it will do you a wealth of good if you will sit down and go through it and kind of understand it. That's really why we built it, and why we hope folks can put that into place. So that being said, I'm just going to cover some of the high points. Once again, we got the video out on the site for this that goes into it in detail, so you can stop it and enter information and start it and what have you. But didn't want everybody to go into it blind. The first thing you'll notice in the template that we use is what we refer to as our simple numbers, profit and loss. So it's a very basic input of just a handful of accounts that make up your profit and loss statement. Once again, simple numbers, we try to keep it simple. Don't overthink this. Put in what you can. Use other operating expenses as a plug to get your net income. Just keep it very, very basic. But what we're going to ask you to do is to go back about a year's time and by month and enter this information, because we're trying to get what the trend is looking like leading up to this. Okay. So that's first one, is to go back in time and kind of put some actual data in. Step 2 is you're going to do the same thing for your balance sheet. And the template, we've got what we refer to as a non-traditional view of your balance sheet. And there's a conversion template, if you think of it in more of a traditional format, that will, you put it into that template and it will give you the numbers into this format. The reason why we chose this non-traditional view is because it speaks to things in terms of those different capital buckets that we talked about. What am I going to need in trade capital to float my AR versus what I'm getting in AP and deposits? What am I going to need in infrastructure if I am going out and buying vehicles or what have you? What am I going to need in buffer, and then the restarting of the business? So enter your actuals there as well. Once you get that put in, it's a pretty simple process from there. In terms of working on the forecast. And as I said earlier, at a high level, forecast is more of an art than it is a science. And so to properly do so, kind of think, these are some questions for you to consider to walk yourself through forecasting over the next couple of months. Start with the top line revenue. What do I know based on my leading indicators that revenue is going to look like immediately? In the example Jeff gave, We were closing the stores. Well, that's pretty easy. It's going to look like zero unless we've got online orders. So what is the impact going to be? I had a client that we did this for yesterday. We looked at the past week of activity because that was the most recent data he had available that gave him a good idea of what trend was going to be. The next question after 90 days or so is, best we can tell, when are things going to come back to more so normal? It's a guess at this point in time. That's why each week, as you have more information, you may come back to the tool and update accordingly once you find out what things are going to look like. It may take quite a bit of time for things to get back closer to normal. So as you look further out past 90 days, to the rest of the year, it may take all the way to Q4 till we start to see activity getting back closer to maybe as you entered the storm with. So that being said, will you pick up some market share? Do you have an idea of perhaps, hey, I've got some competitors that came into this without a full tank of gas and they're not going to make it through? Well, if that's the case, I can forecast out a couple months in advance, actually picking up some market share and potentially even new offerings. So keep those things in mind because these are all those things I mentioned earlier that are going to impact how much capital we're going to need to relaunch the business. All right, any questions on that part? Feel free to send those over. Happy to answer them. From there, you're forecasting the operating expenses. And as we said earlier, like Jeff mentioned, trying to get things to absolutely bare bones operations. What can we do to reduce or eliminate some of these operating expenses? The FDIC has already been in touch with banks several weeks ago to say, work with your borrowers. If you need to suspend payments, if you need to have them if they need to go interest only, do so, and you will not be dinged from an FDIC audit perspective. It's not going to hurt the borrower. So go ahead and get in touch with these folks and see what they can do to lower your obligations there. Another one, unfortunately, I got a lot of clients that are in marketing, but right now, if folks are not looking to make purchases, then reduce those marketing purchases, or those marketing spends rather, and reserve that dry powder for whenever they're ready to. Kind of go, scale down, go to minimum level and reserve. And then, obviously you're looking at your team there, should we need to make temporary decreases or what have you. Okay. From there, you can look and see, okay, what is, given the running levels that we're going to have, what is it going to cost in my direct labor costs, which are the folks who actually provide the service or the production to the end user. And if we're seeing a reduction in top line, then there should be a corresponding reduction there as well. Obviously, we would not need to necessarily, all else considered, keep the same amount of payroll employee. That said, we're going to be cognizant, to speak out of both sides of my mouth, of the loan forgiveness under payroll protection. If we get that financing, then we're obviously motivated to keep people paid. So keep that in mind as well. But you're trying to forecast out what may I have to do in the meantime if I don't have the capital to bridge that gap. So keep that in mind. The sixth thing here is looking at drivers, and this is more so around the balance sheet activity and looking at how long does it typically take for you to get paid. Looking at your days outstanding from whenever I issue an invoice, how many days is it on average until I get paid? And that's where the historical information comes in handy because we'll have that's built into the template to the tool. It tells you what your DSO is ran at, so you can then plug it in moving forward. But that said, plan on days outstanding increasing. For most of our clients so far, this is the 1st of April, they haven't, but just generally speaking, seen a massive change in receivables yet, but that's coming. So as you get further into April and into May, it may have taken 45 to 60 days to get paid. We may see that increase to 90. So, plan for the worst in those cases. Same thing on the other side of the ledger with your vendors. If you normally pay, within 30 to 60 days or 30 days to 45 maybe, can I extend that to 60 days? Because I'm trying to take advantage of all the resources I may have available to get through this from a cash flow perspective. Those are two real important ones. And keep in mind that whenever you start to come back into activity, there will come a point in time to where I probably have to start paying my vendors in a more timely fashion. They're not going to allow us to do this forever. And hopefully your receivables will turn back to as they had ran historically as well. Okay. if you carry inventory, if you receive deposits from customers and what have you, go ahead and forecast that out as well. As we mentioned a moment ago, you likely have some inventory now if you carry it. That's going to get you through perhaps the reduction in activity. But then whenever the orders turn back on, I've got to plan for that increase in inventory again. So work through that in the template. If I am in the event business or the restaurant business, you may actually start to see prepayments for room reservations and other types of services increase. One caveat there is keep in mind, just because that's the way it worked prior to COVID doesn't mean it's going to be the way that it works after COVID. In terms of other people may be cash strapped as well. So don't always automatically think I used to always get paid in advance. I may have to change my stance on that a little bit. Or we may see people in the industry kind of break rank. So plan some worst case scenarios there to where if people no longer pay me in advance and I have to start taking terms, what would that look like? Number 8 here, and like I said, for the most part, a lot of folks are not needing buffer infrastructure capital right now. That said, if you do have loans with the banks, as I mentioned earlier, contact them. If you've got loans with General Motors or Ford Motor Credit or Enterprise Leasing, call them and explain the situation and work something out so that you can defer some of those payments. Right now is a unique situation and they're actually being very generous. I've actually had a couple of clients have their lender reach out to them and say, hey, if you need to defer things, you can. So make sure that you do so. And then obviously stay on top of the resources that are going to be available, the payroll protection, the economic disaster loans and what have you. There are states, I know particularly the state of Florida has somewhat of a bridge loan for about $50,000 right now that they can offer people to help get through in a short term some of the challenges that they're facing. So stay on top of all of the things that may be available to help you there from a debt perspective.
Hey, Brandon, one question coming in here, and we're going to come back. Jeff's going to talk a little bit about the PPP program and other programs, but regarding working with lenders, Brandon, does that apply equally to long-term debt, short-term debt, line of credit, as well as credit card debt?
Yes, I haven't heard as much on the credit card side of the house. I know that they're trying to work with folks. I haven't heard as much in terms of forgiveness, but particularly with term debt, then I have heard many more banks saying, hey, go interest only or let's defer payment. And same thing with line of credit if they need to defer the interest there.
Yeah, and one of the crux of the questions there is credit card debt typically runs about 18% these days, line of credit somewhere around 8%, long-term debt, maybe 4 to 5. How does someone who has more money on their cards restructure to get a lower interest rate? Any recommendations there?
Yeah, so traditionally you'd be looking at a lending program to amortize that out into a lower interest rate. The feedback we're currently getting from banks is that a lot of that stuff's on hold just because of the SBA financing requests that they're currently having. That said, if I can use, if I've typically been using a cash to make a long-term liability payment, say it's $10K a month, and I can get that deferred, I'm going to pay that on the credit card potentially. I hate to give just blanket advice, but if I have available cash flow, I'm obviously going to pay the high interest debt down instead.
Mm-hmm. Okay. Why don't you shut Brandon, and then we'll go over to Jeff.
Yep. Last thing here. So keep in mind, taxes have been put off to July 15th, but they're still going to come due. So if you are profitable during this stage, it may be at a lower level of profitability. Make sure you're accounting for tax implication. If you as an owner have been taking profit distributions, then we need to put that on hold until we get through this time to make sure that we keep our business nice and healthy. And then the last thing here is analyze. Step back and look and see what is the cash flow requirement that I mentioned a moment ago, and you'll see that in the template tool that we've produced. How much cash am I going to need? There's actually a line there that says line of credit, and we emphasize that in the videos to get through this downturn. So how much cash am I going to need? What is the best available options to go and get that cash? And in extreme circumstances, you do have to consider, do I need to just shut down operations and then relaunch at a future time? That's obviously the last thing that you want to have to do. But given, the circumstance your business is in coming through this and what the capital requirements are going to be to keep it going and get it restarted, and the available lending, that's an option some people are going to have to consider if you're just severely being impacted. So, like I said, prepare several different versions of this. More than happy, to answer any questions folks may have. Keith will have my contact information on that. But we really designed the tools, hopefully, so that they're very user-friendly and kind of a DIY approach, because we want you as the entrepreneur to be able to use those and understand.
Okay, Brandon, thank you. And we'll come back to you after Jeff shares a little bit. And one thing to be thinking about, Brandon, owner compensation can be a big variable in privately held businesses. Some owners overcompensate themselves, some are at market salary, which you recommend, and are undercompensated. So we'll talk about that, time permitting. We come back to you in light of the PPP program and the payroll protection relative to owner comp. We'll come back in a little bit.
Sounds good.
Jeff, tell us, been doing some research. You actually, I believe, read the Senate bill that came out of the Senate in the United States. We're a global organization, and I know you've got some input from Australia and Germany. We'll get to that in a little bit, but what can you tell us about what's happening in the programs in the United States, many of which will be mirrored in other countries throughout the world?
Yeah, the CARES Act that passed and was signed by the president last week, unprecedented stimulus, $2 trillion. To give a little bit of perspective, the stimulus package is about 10% of the gross national product of the United States and equal to about 1 year's of business and individual income tax, not including FICA, which is another $1.5 trillion. But this is an unprecedented amount of money. And I've been telling clients, get in line quick, because it may not be enough. There may be way more demand than the banks have access to loan. So be prepared. I sent out, before the sun came up this morning, the SBA loan application for the new PPP loan program. And you can't apply yet. They don't even have rules yet. But right now, the guidance is that you'll be able to apply on Friday if you're a business, and individuals with independent contractors will be next week. So get ready and line up to do that. Keith, if you want to pull up that one sheet, the Small Business Development Center, which is a program that most states have, SPDCs, prepared this summary. It's about the best summary that I've seen of the various offerings from the SBA, which is the vehicle that are being used mostly for the federal program. You have these economic injury disaster loans, which some of which are grants. You don't even have to pay them back. I've not focused as much on that. Most of my time and attention has been focused on the PPP, which is using what some people might generally recognize as a 7A loan under the SBA program. Most of the requirements that I often counsel against using SBA guaranteed loans because they're cumbersome, they've waived almost all of those requirements. So this is one that most businesses, even if you don't think you need it, should kind of line up and see what's available. The maximum loan is going to be 2.5 times your average monthly. This isn't exactly, but it's basically 2.5 times your average monthly salary compensation mix for last year, up to $10 million. So if your payroll and expenses related to payroll are $100,000 a month, you could borrow $250,000. and that the stimulus package is absolutely dedicated to re-employing people. The forgiveness portion of the PPP loan is completely tied to your level of employment after you get the loan. In theory, if you were able to bring back everybody or keep everybody after you receive this loan equal to what you employed in 2019 on a monthly basis, the loan could be 100% forgivable. The permitted uses for these loans are, as Brandon described, people expense, rent, mortgage, interest, and utilities. You can't enter into a new lease. It has to be a lease that was in place or a mortgage that was in place February 15th. But that said, if you have to keep your workforce employed for 2 months to get 100% loan forgiveness, you only have 2.5 times your payroll. So you only have that 0.5 of your payroll to spend on other things such as rent. So it's not going to be adequate to relaunch. It's really, the incentive is to keep people employed, and that's the target.
So Jeff and Brandon, let me ask a very interesting, I think important strategic question. Does it have to be the same people or the same level of payroll? And the reason I mention that, some businesses may need to contract and then move human resource capital to the front end of innovating and rebuilding the business. So is it the total payroll amount, or is it actually employing the same people? Or after cutting back, could you employ new people in the area that will help you grow again?
A little unclear. The rules aren't out yet, but the best information so far is it's FTEs, full-time equivalents. So if you can't hire the exact same people back, or they aren't available, or you redistribute how you need your people, they're going to look at your total payroll and the FTEs that you employ to determine the forgiveness portion. So I think right now it's understood that all of those people might not come back. So the stimulus is intended to get people back in the workforce. So it doesn't, right now the understanding is it doesn't have to be the same people. Now, could we cut people's pay by 25% coming back? That will probably have an impact on how much of the loan is forgiven. The rules are a little unclear right now on how that will happen. It's not just going to be FTEs, it's going to be total payroll expense. So if you have the same number of FTEs, but your payroll is 50% less because you're hiring minimum wage people rather than skilled labor, you probably aren't going to get the loan forgiven. That's all yet to be determined.
So 2 more questions on this, and Brandon, feel free to weigh in too if you wish. So Jeff, in your actual case study, we'll have to see how it plays out. Your company could hire back 2 people focused on innovation marketing, apply for the PP, and the payroll FTEs could theoretically be forgiven.
Yeah, so we might decide that we need a marketing, sales generation, lead generation people rather than frontline salespeople, at least to relaunch. And it appears that would be permitted, particularly if salespeople's compensation is tied to sales and the sales aren't there. We're not going to be able to fully restore their compensation if the retail sales aren't there to support a commission base.
Does it apply to contractors? You use the term full-time equivalents. Does it apply to contractors that were being engaged prior
Yeah,
or not?
it does include independent contractors, and it's a little unclear right now if it's all 1099 people as opposed to employed people. But it looks like you're going to be able to include your independent contractor base, because there's a lot of, I have another client that has 23 independent contractors. She doesn't have but one full-time employee besides herself. So it looks like the Congress recognizes that there's independent contractors and sole proprietors that will be hit by this as well, and we want to get them back to work.
Okay. Brandon, over to you. Any comments on that conversation, independent contractors, and then comments on their compensation for these private businesses and where that might be in PPP
Right.
if you have any comments.
My understanding is the same as Jeff's. Based on the guidance we've seen so far, it looks like that they would be included. But, you know, like everyone else, we're waiting on the SBA to kind of give some final guidance around a few of these areas. So I'm telling folks to prepare, you know, have your 1099s ready, have the data ready, and let's have them tell us no as far as that goes. In terms of the comp level, so, you know, the great part about being an entrepreneur is that at times like this, your comp becomes one of the first things that's on the table for discussion. And so that being said, you know, under the payroll protection program, it's capped at $100,000 in terms of the forgiveness at an annual rate. And so, you know, what I would look for there is, because it would be forgiven, I would look to use those proceeds, if you have them, to pay you to that rate. If things allow at home, which, you know, do everything in your power to make sure that they can try to live off that amount, you know, for a couple of months until the business can get back on its feet. So it's what we refer to as sweat equity, like Jeff mentioned. You know, you may be working 20 hours a day right now and taking a pay cut. That's sweat equity you're having to put in the business so that you can relaunch it.
Mm-hmm. Okay, gentlemen, I'm going to ask for closing statements in a moment. We have two final questions, and we'll finish here just right around the top of the hour. Question from Mike: should you take banks up on deferring payments even if you don't feel cash strapped at the moment? Brandon?
Yeah, so right now, given all of the uncertainty, I lean toward yes, because I can put the cash back today if they allow deferment. If I need the cash in 3 months, good luck them giving it to you. Mm-hmm. So I'm willing to be a little bit more conservative with my cash flow planning and take them up on the offer right now.
Brandon, does that come under possession as 9/10 of the law?
It may.
Okay. And the last question, and then closing statements, was just from one of the audience members. Can we send the spreadsheet out on the screen to attendees? Absolutely. In fact, we're going to send a summary on the CARE Act. We'll send this grid, which is fantastic. Thank you, Jeff. And then Jeff, quick comment, and then your closing comments. What's happening around the world in Australia, Germany? We tapped into coaches and relationships there. What are other countries doing? And you can comment on those two.
Yeah, I think this is a world pandemic, so all countries at different rates are being impacted. We had specific conversations with Australia and Germany this last week. Australia's stimulus package is about a little over 8% of their GNP, similar to what the United States is doing. And Keith, you can send out the list for any Australian listeners. We have a good summary of their programs. As you go down, I happen to look at Canada. Canada's stimulus package is only about 3.6% of their GNP. Mm-hmm. So different countries, and it has a lot to do with the timing and severity of the impact. Mm-hmm. In terms of their response. But almost all countries have some stimulus package, much like we shared with the United States, and should absolutely reach out. in addition to these federal programs, every state, Minnesota, Wisconsin, where I practice, have very specific states that programs that have less zeros than the federal government program, but might just be the difference of survivability and thriving after this.
Okay. Thank you, Jeff. Brandon, closing comments or advice for business owners listening in?
Yeah, I would say have a plan, like I just mentioned. Use the tools we've put available, and any other tools that you can come across. Now's the time. To avoid being bashful. Go, get as much as you can through the payroll protection, other lending resources, the SBA, because we don't know what the future is going to look like. My understanding is there's no prepayment penalties associated with these, and so you can prepay them if you don't need it in 9 months from that standpoint. And know that everybody in the country is going after this. There's going to be delays. So have a plan of the next 6 to 8 weeks of, if you're severely impacted, how am I going to cash flow this time period till I get some of that funding? I think that's the second most critical thing.
Okay. Jeff, closing comments?
2 comments. One, completely unrelated to cash. One of our thought leaders is Kevin Lawrence about taking care of yourself. So I would encourage everybody, these are incredibly stressful times for you and your employees and your vendors and landlords. So whatever you do, you got to take care of yourself first so that you're around to help other people and to make better decisions. And then finally, I just think that at this moment, cash is king. Hoard your cash, meet it out very sparingly where you have to. I'm very good with deferring payments, but American Express has offered to let you not make a payment this month, but at 19 or 20% interest, that's a pretty expensive deferment. So just be careful. It's one thing to defer a payment, just understand what that deferral is going to cost you.
Okay, thank you everyone for listening in for our Global Business Leadership Forum, Cash Part 2. And Jeff and Brandon, if we invite you back in the future to help our entrepreneurs and business owners, would you join us again?
Absolutely.
I'm more than happy to. Anytime, just let me know.
Okay.
Happy to help you when we can.
Thank you so much, gentlemen. Thanks for listening, and everyone. Next time, 1 week from today, same time, 1 o'clock Pacific on Wednesday, the 8th of April, we'll have our next topic. And I want to be clear too, we're not advertising the topic right now because this economy is changing weekly. So what we do is we listen to leaders and coaches worldwide. We go into the weekend to think about it, and then we launch the topic after getting what the market wants in the next week. So just a heads up on that. Take a look and keep an eye out on our website. Thanks to everyone for listening.